Hello everyone, this is Gary Wilson and welcome to tonight's live webinar for the Investor Agent Training Program. And again, as usual, we likely will have some folks on here who are in either the rental program or the flipping program. In other words, we have programs specifically focusing on those subjects, and they're live programs, and we've had students who've taken one or both of those and are also in the Investor Agent Training Program. Or they haven't, and we like to bring them on board because they're great to get examples from. Okay, and they learn from this just as well as you guys learn from them. So, in any case, we are live. We're recording. I appreciate everybody's participation. And what we're going to do tonight is, because we're at the beginning of the year, usually once every quarter, I will cycle through the training material in the sequence that it's delivered to you, okay? And the reason I mention this is just please remember that these webinars typically are not in sync with the material that you're learning. And the reason is we like to keep this an open forum, totally unscripted, unfiltered, and we like to focus our subjects on what you guys are asking us to focus on, okay? So now if I haven't heard anything being asked for quite a while, or I think it's been too long, as a default measure, every quarter we will cycle through the training material from start to finish. It usually takes about a month to do it. Okay, so we're into the second module tonight. Last week we went over a little bit of the very beginning basics and touched on module 1. Tonight we're going to do part of module 2, the rental part, and then next week we'll do the flipping part. Okay, so in any case, welcome aboard. We've got a couple of examples that we're going to be going through tonight. As far as people looking at rental properties and determining cash flow. So I'm going to start by giving an example, and then we're going to go in to this blank one here. We're going to ask either Kelly or Ray, probably Kelly, we're going to unmute her and get some actual live numbers. So hang on to your seat while I back up briefly to this, okay? All right, so everybody just take a deep breath, and you can put your pencils down for a moment. You can keep them in your hand if you want, or get your calculators out, or use your phone to walk through the example with me. I'm going to give you one example of a rental property, and we're going to calculate net operating income, okay? We're going to calculate what's called cash-on-cash return, and of course we're going to calculate cap rate, okay? This is the basic formula. That's what this is right here. Okay, very basic, and we're going to use an example to walk through it, and then we'll use one of your examples. Okay, so first things first. We have a sample property here, and the gross monthly rent is $1,150. That's annualized at $13,800. Okay, and that means per year. That's what we mean by annualized. Okay, we break down the rents by unit. First floor is $450, second floor is $625, and the garage is $75 a month. So that's how you come up with your gross monthly rent of $1,150. All right. So we know we have a gross annual rent of $13,800. That's total rents coming in, not factoring in anything at all for vacancies and uncollected rents and so forth. Okay. Now out of that, we're going to have what we call fixed and variable expenses, okay? And I'm going to give you just the basics, okay? We just want to give you basic stuff tonight so you learn the formula. So under expenses, a fixed expense is something like taxes. In this case, it's $695.96 per year. By the way, this is an actual live example from years ago. And the reason we say taxes are fixed is because your property taxes generally don't change on a monthly basis. They might change every couple of years depending on where you live in North America. Excuse me. Insurance is also fixed. In this case, it was $322 a year. Okay. Again, it's not a variable. It doesn't change monthly. Water, on the other hand, is a variable. In most parts of North America, water service is a lienable item. What that means is if it doesn't get paid, they can lien the property, put a lien on the property to encourage the owner to pay it up. So the challenge with rental properties is if you're renting a property out and you want your tenant to pay the water bill, you better stay on top of things, because if the tenant doesn't pay, it's going to come back on you as the owner, okay? Another variable would be maintenance and repairs, okay? These are basic fixed and basic variable expenses. Now this is a broad category. If we'll look at what's called the opportunity evaluator here in a second. That's what this is. you can see there's a lot of possible expenses, okay? But back here, we're going to just keep it real simple. So expenses, we're going to say, are averaging $600 per year or $50 per month. So if you look at this and you calculate your gross rents, which we've done, now you calculate your gross annual expenses and multiply that by, or excuse me, divide that by 12, you can see your monthly net operating income. If you divide all these figures here, add them up and divide by 12, you reduce your monthly income, $11.50 per month, by this amount, broken down by 12 months, and you're left with $899.46 per month. That's what you have after your taxes, insurance, water, maintenance, and repairs. You're left with $899.46 per month. Multiply that times 12, okay, and you have a gross net operating income, i.e. income minus expenses, net operating income, of $10,793.54, okay? Now, we're not done yet. That sounds pretty good. You're like, hey, I'm going to make, essentially $10,800 a year. But in most cases, you're going to have a mortgage on the property. So let's assume you paid $70,000 for the property, okay? Or let's say this is a new property you're going to get on a contract, and you're going to get it on a contract for $70,000, and that's low. That's the kind of thing you might see in Dayton, Ohio right now. Down payment of 20%, because I always encourage you to put down your own money and put down 20 to 25%. 20% of $70,000 is $14,000, okay, which leaves you a mortgage of $56,000. Now, right now, you can still get a commercial rate at 5% for 20 years, okay? It doesn't matter where you are in the country. You find the right lender, you can still get this, okay? So if you calculate it, if you amortize what $56,000 is over a 20-year period at 5% interest, you'll see that your monthly mortgage payment, just principal and interest alone, not taxes, not insurance, just debt service, principal and interest, is $369.58 per month, okay? Now, if you take this amount and subtract it from your monthly, right here, monthly net operating income, $899.46 minus $369.58 leaves you a cash return, cash in your pocket, of $529.88. So let's repeat real quick. Your rents less your expenses, non-debt expenses, is $899 a month, minus your mortgage payment of $369 leaves you a in-pocket cash flow of $529.88 per month. Now let's multiply that times 12. And when we do that, we find out we are earning $6,358.56 per year for this property. Sounds pretty good, doesn't it? That's about a $500 a month cash flow. Okay, again, it doesn't account for vacancies and uncollected rents and so forth, all right? Those things are real possibilities. For this exercise, we're just trying to go through the exercise so you understand the formula. Here's how we calculate our returns. Most people have heard the term cap rate. Cap rate is very important, and let me describe this to you here, okay? Cap rate doesn't just reflect your return on investment. Cap rate also reflects your risk, the risk involved with the investment, okay? It's a risk-reward ratio. This ratio happens to be 15.4%. On the surface, you're thinking, holy smokes, I'm going to make 15% on my money. And the answer is you sure can if everything works out. But you have to account for risk. So the risk ratio for this property is also 15.4%. What that means is, if you had a 5% cap rate, sure, you're not making a lot of money, but your risk level is very low. You've got a 5% chance of things going wrong. On this property, you've got a 15% chance of things going wrong, okay? The rent to cost basis ratio is an indicator not of just the power of this investment financially, but also the potential risk of this investment because of where it is located geographically, perhaps the age of the property. I mean, the bottom line is the numbers are always going to reflect accurately what the risk is on the property. And again, risk can cover multiple categories. So how you calculate cap rate is this. You take your net operating income for the year, and I want everybody right now to get out a piece of paper and pen or pencil, or use your phone if you want, or if you have a calculator handy. And what you want to do is you want to divide $10,793.54 into $70,000. That's your cost basis. That's what you're purchasing for the property. Okay. So $10,793.54 and the $70,000 gives you a cap rate of 15.4%. Okay, that's how you calculate a cap rate. NOI, net operating income, divided into purchase price or cost basis. Okay, that's cap rate. What savvy or what experienced or real investors like to see is what's called a cash-on-cash return. What that means is your actual dollars out of pocket. In this case, it's $14,000 out of pocket. That's your cash you put into the property. Okay, and your cash in your pocket is $6,358.56 per year. All right. So to calculate cap rate, what you do is you take your cash return, and divide it into your out of pocket or your money into the property. In this case, down payment. So $63,558.56 divided into 14,000 gives you a cash on cash return of 45%. Okay. Pretty darn good cash on cash return in my book. That's an excellent cash on cash return. But the reason this is important is this: cap rate, if you notice, does not account for debt service. Cap rate is calculated based on your net operating income, which is gross rents minus your fixed and variable expenses, non-debt expenses. Okay, income minus non-debt expenses gives your net operating income. You divide that into your actual total purchase price of the property. All right, that's cap rate. Cash on cash return is strictly a cash basis calculation. What's money in your pocket divided by how much you actually put out of pocket, and that's your cash on cash return. So let's do a quick pause here, and let's see if we have any questions on this example I gave you. So let me go back up here, and let's see. This is from Kelly. Hi, Kelly. Let's see. Kelly is, I'm sorry I do not have a mic on or available at this time. Okay, no problem. We'll just use the information you're keying in here. So purchase price is $157,000, paying cash with about a $2,000 in closing costs, rehab of $5,000, monthly rent is $1,350, annual insurance is $900, and property tax is about $1,500. Okay, so let's see. Insurance $900, property tax $1,500. So we're going to use that, Kelly, next. Let's see what other questions we have first. Okay, how would you explain cap rates below 5%, which is common in Los Angeles? And this is from Shannon. Hi, Shannon. Yeah, the example I'm giving here is probably from like Columbus, Ohio, Pittsburgh, somewhere like that. In Los Angeles, you're certainly going to have much lower cap rates, okay? In fact, 5% in LA would be generous. I mean, I know that there's areas like Watts, for example, that could be kind of rough areas. You'll have higher cap rates in those rough areas. And remember, cap rate, Shannon, reflects not just reward but risk. So if you go to Watts, which historically has been kind of a rough area of LA, and you see a 10% cap rate, don't get too excited. You can make 10%, but you're going to work a lot harder for it, and your likelihood of actually realizing that full 10% is not going to really be 100% reliable, okay? Because 10% of the time you're going to be fighting some battles, all right? So remember, cap rate represents risk plus reward. There are areas, and we'll just use California as an example here, that I know of personally because I've been there and invested, is up in San Francisco area. I've partnered with people who are buying properties that actually have a negative cash flow. I know that sounds unusual. Why would somebody buy a property with negative cash flow? Well, the reason is they're banking on the other side of the equation, which is appreciation, capital appreciation. They're willing to wager that a property they're purchasing, even though it may cost them a few $100s per month out of pocket to feed the thing, over time is going to far more than reward them for their efforts and their out-of-pocket costs because of appreciation. Now, what generally people do, by the way, this is for Shannon and everybody, whether you're in San Francisco, LA, or other high-priced areas like Washington, D.C., Toronto, even certain areas around Boston, okay? you're going to have lower cap rates. It's just a factor of those marketplaces. Now, what investors do to counter that is this. They actually will put more money down on the property and finance a lesser percentage. So you might find people putting down 50% cash on a property and finance the other 50%. I know it sounds crazy, but believe it or not, there are a ton of people who do that. In fact, a lot of investors that we work with those areas, the chiropractors and dentists, for example, that's what they do. We have investors putting down all cash, and the reason is they're simply parking their money in a tangible asset. That's all they're doing, guys. They're simply parking their money in a tangible asset in an area where they're pretty certain values are going to continue to go up. You know what? And I agree with them in some of those areas. So not very glamorous, but let's face it, I can tell you this, 2 years ago, I know Laguna Beach, because I was looking in Laguna, was appreciating at an annual rate of 15%. Now, I would do a break-even purchase out there. In fact, that's what we were working on, a break-even purchase. On a monthly basis, we were breaking even on cash flow because we were banking on a 15% appreciation on a property. So it's just like if you bought a stock and the stock went up 15% in value on an annual basis, most people would be absolutely thrilled with that. My gosh. And it's the same thing with real estate. People are thrilled to get 15%. That's why they'll do it, guys. So I know it seems like, hey, that's not what we learned watching Carlton Sheets at 5 o'clock in the morning, but that's because Carlton Sheets wasn't working in this type of a marketplace, all right? So in any case, hopefully, Shannon, I covered your question. Let me flip forward here and see if I did. Okay, Ray has a question. Cash on cash return. This wouldn't be done by year because down payment is only first year. You would have to do rolling total. Actually, the way it works, Ray, is you cash on cash return, you calculate on an annual basis, but you always go back to what was your out-of-pocket cost. Okay, so you don't change that. Your out-of-pocket cost is fixed. In other words, you put down $14,000. Now, let me qualify that. If you make capital improvements on your property, in other words, you put in a new roof or you put in new furnaces, those are things you don't expense typically. You'll depreciate them over time, which means you also capitalize them. And for everybody else on the call, what that means is if those are out-of-pocket costs, and let's say you put $14,000 down on a building, and 2 years later you put on a roof for $5,000, now your cash out of pocket is $19,000. Okay, $14,000 for the initial down payment, $5,000 for the roof is $19,000. Then yes, you're constantly looking at your cash on cash return on an annual basis. Okay, what is your cash on cash in pocket return? Always divided by your cost basis, which again essentially is going to stay the same unless you do some capital improvements. That's when that changes. So Ray, to answer your question, is this actually generally won't change. So the second year, if this goes up or down, my cash on cash return is going to change, but it changed because of this, not necessarily because of this. Okay, does that make sense? And I'll look for a response. So let's see what's coming up next. So Shannon's asking, so reward is more on the appreciation? Absolutely, Shannon. So when you're in high-priced areas, see a lot of people who are tied to the area because of their business, again, like chiropractors and dentists. They may have multiple offices themselves, multiple practices, and they want to invest in their own area because they live there and they want to see their properties. They don't want to invest in Indianapolis or Cincinnati or Columbus or anything like that. Okay, and what they do is it's just a different strategy is all it is. So you're exactly right. They're going for appreciation, and I've done that too in a number of areas. Let's see here, Tammy. Okay, this is Tammy. Hi, Tammy. Tammy is asking, would you kindly go over the cash on cash return rate one more time? How do you calculate it? Absolutely. So cash on cash return, Tammy, is you're taking your income on a monthly basis, and this is your income, your rents, where you've already netted out your expenses, and you also net out your monthly debt service, which is your mortgage payment, interest and principal, if in fact you have one. Okay, so the cash on cash return accounts for debt service, whereas the cap rate does not account for debt service. Cap rate only accounts for your your income minus expenses, okay, not including debt service, income minus known expenses, not including debt, divided by the total purchase price of the property. That's net operating income. Cash on cash return is cash in pocket after all expenses, including debt, divided into what you put out of your pocket. Your down payment, for example. In other words, you only put down 20% or $14,000. You're going to divide your cash in pocket on an annual basis into what cash came out of your pocket, and that gives you your cash on cash return. So if you get out your phone, divide 63, 58, 56 into 14,000, you should come up with 45%. As long as the person who put this together usually did it correctly, but that looks like it's about right. In other words, 6358 is slightly less than half of 14,000, so that does make sense. That's about a 45% cap rate. And Tammy, in Northern Virginia, you're going to be closer to Shannon out in LA. You're going to be closer to those kind of figures as far as cap rates and cash on cash returns. LA is really weird because it's so huge. You've got areas there where the average home price is over $1 million, and you got other areas where the average home price is only like, 200,000. Or even there's some areas actually that were down below 200,000 when I was out there. So it varies widely. I mean, a lot of areas do, but Washington, D.C. is a lot more static. It didn't get affected by the recession at all. In fact, not like L.A. and some of the other areas like Phoenix. Okay. So Tammy, let me know if that works. And the best way to learn this stuff, guys, is to practice it. Okay, I'm going to show you the blank formula here in a second, and it's all in your training manuals in Module 2. Just simply practice it. Get out the calculator, get your own examples, and practice them. Okay, so this is Ray. Ray is asking, doesn't maintenance and repair cost and debt service become the only cost each year? So the costs are what I would. Here's the difference, Ray. So cost would be. I'm going to say. You're meaning expenses, cost being expenses, okay? And you're asking if they're the only cost each year. Well, what I'll do is I'm going to go to another calculator and I'll show you what other kind of costs you can have. In this example, we try to keep it simple and basic just to demonstrate the formula. But I'll go ahead and branch over here and show you the Opportunity Evaluator. That's what this is, okay? In the Opportunity Evaluator, up here is where you calculate your debt service, your loan payments. But down here, Ray, look at all these expenses. Okay, under operating expenses, you've got taxes, insurance, management. If you notice, management was not in this formula here. We didn't use it. But management in bigger buildings is an absolute necessity. In fact, even if you are investing yourself or you have investors and they're starting off small so they don't have management, I would write this next thing down. What I'm going to tell you guys is always include a figure for management. Always include a figure for management, because even though they might not pay for management now because they only have a couple duplexes, once they get to 10 or 20 units, they're going to want management, and then that cost is going to be there. And here's the kicker. Think about this. If they did not account for management at the time of their initial purchase, and all of a sudden they later have to account for it, they may have paid too much for the property to be able to pay for management and still have a decent return. So even if you have a client, again, or you're purchasing a rental yourself and you don't want to pay for management right now, still include a percentage for management, because later on you may decide to pay for management. Very important, okay? Also, you may have some payroll expenses on larger properties, or if you got a lot of duplexes, for example, you might have utility costs other than water and sewage. I generally on rentals don't pay any of this stuff. On big buildings, I will pay gas if there's central boilers, for example. But here's some other ones. What about accounting and legal? So every year you've got to pay someone to prepare taxes for you. At least most people do. And when you buy rental properties in an LLC, your tax, the effort to prepare your taxes is going to grow, as your investors grow. So you want to account for these expenses, okay? How about licenses and permits? Let's say you've got to do a roofing job and your area requires a building permit. You want to account for those. Advertising. How do you promote your vacancies? Well, you're going to advertise. Supplies, salts, shovel, and if you're in the northern areas for sure, shoveling snow. Fertilizer, pest control for people who suffer, who have termites and ants and things like that. Okay. Lawn service, trash service. These are all real expenses. Snow removal. Okay. All these expenses are what's possible when you own rental properties. The more you own and the bigger the properties you own, the more these come into play. The reason I like this formula for beginners is if you're just buying your first duplex, you're going to probably do a lot of things yourself, so your cost will be minimum. Okay, most people do that, and I was the same way. And over the years, I started delegating more and more of the activities. Okay, excellent questions, guys. You guys are rocking and rolling tonight. Okay, so let's see. Shannon, follow-up question. Okay, follow-up question. The cap rate question and the appreciation that LA can provide. What is your cash-on-cash return range that follows a lower cap rate city like LA? Good question, Shannon. And I've some of the guys I work with, Shannon, are, and I just tell you some of their names. Andrew Cushman's the guy. He's right below you. He's kind of down towards Laguna, I believe. They're looking at the cash-on-cash return depends a lot on how much money you're putting down. Okay. Now I know the people who are getting a 5% cap rate. If cap rate's only 5%, they're generally looking for a 20% cash-on-cash return. So this looks very high, which it is. But if you had a 20% cash-on-cash return, what that means is if you put down $10,000, you would only be getting $2,000 a year. Doesn't sound like much, but 20% is a pretty darn good return. So to answer your question, Shannon, I do know of certain areas and certain investors who will go all the way down to 10% cash-on-cash return, but as a general rule, you'll find this pretty much across the board. 20% is about the least people will accept in a real estate investment. Cash-on-cash return, minimum 20%. Good questions. Okay, let's see here. Tammy, got it. Thanks. Okay, you're welcome, Tammy. Okay, so let's do this, guys. I want to show you this. Again, it's in I think it's page 72. Yeah, this is page 72. So what you can do is everybody got this in the second module. If you haven't gotten your second module yet because you're still too new, it'll come out once you've been in your first module for 7 days. And just cut and paste this, okay? And save it on somewhere in your file structure, okay? And you can play with it. You can print it out and do this one on paper by hand, okay? And just bring in any example you want. So, boy, I wish, I wish I had, doggone, I should have thought, if I'd have thought about this before, let's see. Yeah, I tell you what, Tammy, or Kelly, I'm sorry, it was Kelly. Let me put my head together and see if I can come up with a way to do a quick example of this using your numbers. Because right now, if I do it, I'm not going to be able to type anything in here because I'm in a webinar. Unfortunately, in other words, I won't be able to type it in where you guys can actually see it. All we can do is walk through it. So your example, let's go back here. I believe you gave me a pretty good example, and let's see if I can find it. Hang on one second. Here it is. Okay, purchase price $157, and so everybody, here's what everybody get your pencils out and write this down. Write down purchase price $157. Okay, write down $2,000 in closing costs. So you can put down cost basis of $159,000. In other words, $157 plus $2,000 closing costs is $159. All right. Rehab is $5,000. So now you add $5,000 of that, which now you're going to have. So you're going to have $164,000 cost basis. $164 cost basis. Okay. $5,000 rehab plus $2,000 closing costs, and plus $157 in actual sales agreement price gives you $164. Okay, so $164 is what you're putting into it. That's your purchase price, I guess. All right. Let's see now. Rehab. Oh, we talked about monthly rent is $1,350 a month. Okay, so write that down. Annual expenses is $900. I'm sorry. Yeah, 900 is annual. Okay, 900 is your annual. tax burden, or annual, insurance burden. So 900 divided by 12 is about $75 a month. Property tax is $1,500, which is about $125 a month. So write down $125 taxes, $75 insurance, which is a $200 a month expense rate for taxes and insurance. And I know that can be built into your mortgage, but it's still an expense. All right. So how would you explain? Let's see. Is that it? Oh, I think that's it. Okay. So now what we don't have, Kelly, is your mortgage information. If you can tell me what if you can calculate this, Kelly, you can Google amortization, and you'll get all kinds of free calculators where you plug in your loan amount, your interest rate, and your term, and it gives you the monthly payment. So if we had your monthly payment, we could plug it in here, all right, and figure out cash flow, because we've got your gross rents, we've got your taxes, insurance, maintenance, repairs. We'll have your gross rent, we'll have your expenses, we'll have a net operating income. Then we can plug in your mortgage payment, and eventually we'll get the cash flow. Okay, so let's do that in a second. But what we'll do is, if you can give me that, Kelly, or if Ray, you've come up with an example of your own, I will go to the rental property reporter. Actually, I will go to the opportunity evaluator next, and we'll plug in the values there and exercise that horse. Okay. Let's see. I have a cash flow example. Okay, so Ray, I'm going to hang on one second. I'm going to go into the opportunity evaluator, and Ray, I'm going to find you on the attendee list, and I'm going to unmute you. So hang on one second there, big fella. Let's see. I need to find Ray. Okay. Okay,
Good
Ray.
evening, this is Ray.
Ray, you are unmuted. Can you hear me okay?
I can hear you. Can you hear me?
I can hear you. Yep. Sounds like you're coming through your computer's audio. You're basically your microphone's on your computer. So make sure you stay close to your computer, because if you move around a lot, it'll get real wavy. So,
Okay, thank you.
So let's do this. Let's start off with. Do you have the purchase price of your property?
I do purchase price $112,500. 112,500.
Okay. And let's see. Let's go down here. What's the initial loan amount?
Initial loan amount 112,500. That's not what you said. You said probably put 20% down, right? This is for an investor. So.
Yeah, I like to put down 20%. So if you calculate 80% of 112,500,
30,000.
Yeah, you should get an initial loan of somewhere probably around 90,000, I think.
Right.
Let's just
initial loan.
Let's just make it 90,000. Okay. Now do you want to number of payments per year? Say 12.
Well.
Interest rate. Do you know what your interest rate is?
I just got a loan of 375 for my house.
375.
This is for an investor. Yeah.
Okay, we can do that. You can do that. Amortization period years. You want to say 30 years, 20 years, 15?
Do 30.
30 years, okay. And
what investment is? Does investment change that term? Most people get a 30-year mortgage.
Well, you can.
Most investors.
Yeah, you can. Number one is you can definitely do 30-year loans with small investment properties when you're first starting out. Now, here's what I advocate. What that means is generally you're going to be getting FHA loans, which I don't like, because they will destroy more transactions than I've seen actually work out. So I would say let's use this as an example. However, I'll tell you, over time, for everybody on the call here, when you're investing yourself, try to very quickly move to commercial loans for 20 years. Okay, your payment won't go up that dramatically, and yet your amortization is going to be reduced by obviously 33%. Okay, you'll pay it off in 20 years. It's just a better way to do business. Commercial loans are easier to process than FHA loans, but you can also do conventional loans for 30 years. Don't go FHA if you have to go 30 years and try to get a conventional loan. So in any case, back to the example here, you can see we have a monthly payment of $416.80. And our initial down payment is $22,500, and of course the loan amount's $90,000. Okay, and let's just avoid points and other acquisition costs for the moment, just so we can get through the example. So now we've got our purchase price and our mortgage information. Now we have rents. So Ray, this is a single unit. Is this what you're looking at, if I recall?
Yes, it's a single unit. Rents for $1,200 a month.
1,200. Okay. And whoops. So there's only one unit at 1,200 a month. So that gives us an annual gross receipt of 14,400. Okay, you with me so far?
Right.
Okay.
I'm with you.
Okay, excellent. Now let's move down to expenses. Do you want to factor in a vacancy rate? I can tell that the app.
No,
Okay, let's leave that.
I'm in Portsmouth, and things are in the market less than 30 days.
Oh, I like you, man. You're good. Okay. Now, do you have other income, like from laundry, for example?
No.
Okay, I wouldn't think so on a single-family home. Okay, do you know what your annual taxes are for the property?
They're about, let's see, for this, they would be, let's call it $2,000 a year.
Okay. And how about...
I should put 3,000.
Okay.
Thanks.
Yep. How about annual insurance on the property?
$800.
800. Okay. Let's say no management for right now because it's a single-family home, no payroll. But maintenance and repairs, I would plug in a figure here just to project forward for it. Even though it's a single family, yeah, that will be high. For a single family home, your tenants are basically going to do everything. They're going to cut the grass, shovel the snow. They'll do everything. But you might have, an annual furnace inspection. You might have a just some basic stuff, replacing doorknobs and things like that. So let's call that 600. That's even probably still too much, but that's okay. Now, because it's a single-family home, you'll have no utilities. Your tenants are going to pay all utilities. Is that right?
That's correct. What you said about water, I have a rental now. I'm paying the water, and because my wife, the realtor, recommended it for the same reason you said earlier.
Yeah.
That water is intaxable.
Is it a single-family home?
Yes.
Okay, here's what you do. And everybody put on your earphones. This is a big hit, hint, excuse me. If you're renting single-family homes, yes, you should keep water and sewage in your name, but here's what you do. You put in your lease that the tenant is responsible for paying water and sewage, but they pay you. So what you do is you, the owner, pay the water and sewage bill, and you invoice your tenant for the same amount. You send them a copy of the bill, and they reimburse you on a regular basis just like they pay rent. And if you put it in your lease like that, number one is if they don't pay you for the utility, if they don't pay you for water and sewage, you can evict them just like you evict them for non-payment of rent. The benefit to you is you stay in control of making sure that lienable item gets paid so it doesn't ever get behind. That's how you solve that. So yes, keep it in your name, Ray, but I highly recommend next time you renew your lease, say, hey, you know what? You guys are going to have to start paying the water and sewage. I'll keep it in my name, but I'm going to invoice you, and I'm going to document it in the lease renewal. Does that make sense?
That makes sense.
Excellent. That'll help your bottom line. Okay. Now, accounting and legal, you might want to say $100 a year because you might have to pay for a tax return or evict somebody or something like that. Advertising, maybe $50 because it's a single-family home. They might move out and you got to advertise it again. Tenants are generally going to pay for all this other stuff. They'll pay their own trash, lawn care, snow removal. So you can see your expenses went up to $4,500 almost with no effort at all. That's a lot of expense. And now your net operating income is $9,900 because you take your gross receipts, $14,400, minus all your expenses of $4,500, leaves you a net operating income of $9,900. And if you now subtract your debt service of $5,002, okay, that's this $416.80 multiplied by 12, okay, gives you $5,002. And now you're left with a cash return of $4,898, almost $5,000. So there's some good news and bad news here, okay? Good news is this. Your debt coverage ratio, which means the amount of income that's available to pay for debt service, this is what the bankers look at, is high. 1.979 is very high. banks like to see in hard times 1.75, so you're even above that. Okay, in soft times they like to see 1.25. Now the downside is your cap rate is only 8.8%. Now if you're in LA like where Shannon is, or if you're where Tammy is and Ken over in Washington D.C., 8.8 ain't bad. I take that every day of the week in those areas, Boston, Toronto, you name it. But where are you located, Ray? I'm trying to remember where Dawn is.
I'm in Portsmouth, New Hampshire.
Okay.
And this is a investor that my wife talked to today.
Okay. All right. Well, 8.8 is not bad for Portsmouth, New Hampshire, because I remember the area well. By the way, beautiful area. I loved it up there. Man, you guys are. I know it's cold right now, but it's a beautiful area. So in any case, 8.8 is not bad. Okay, for up there. By the way, you're up near Dave Gambasini. He's also in Bedford, New Hampshire. He's an awesome agent. He just moved in the commercial. He went through the training program and moved up to the commercial just in the last month. He's doing really well. So look him up. Look up Dave Gambasini. Yeah, he's a great. He's very open, and he's got a good heart, and he's a very smart guy. So, in any case, so everybody, show of hands here. Let me. And I'm going to keep you live for just a second. Right, hang on one second. But I want to check for questions here. Let's see. Oh, Kelly said this is a cash flow. So Kelly, we're going to plug yours in next, okay? Kelly says, I would like to compare it to 20% down and 5% interest. Okay. Peter says, what does DCR mean? Oh, so Peter, hi Peter. Speaking of the Boston area, Massachusetts area, Peter's from up there. DCR is debt coverage ratio, and what that means, Peter, is how much of your net operating income, in this case $9,900, is available, or how much of your income is available for covering debt service, and in this case, the ratio is 1.979. That's really, really good. So if we played with expenses, like let's say we made this 10,000. Which would be ridiculous, but let's just see what happens. Look at that, debt cover ratio goes to negative. They would never agree to that, but let's say it's 1,000, and that would never happen. Accounting legal, that's still pretty high. Let's say 5,000 and see what happens. Okay, now you're down below 1%. So you can see, Peter, this is heavily influenced by expenses. Okay, the reason. We had it very well, I think $100. So what banks are looking at is if they see that you have a very high expense rate compared to your gross receipts, they're not going to want to lend a lot of money on the property. That's what it comes down to. The bottom line is they want to know how much your money is available for covering debt service. That's what that coverage ratio is. Let's see. Peter says, and how often do you use the field what if cap rate is 10% and why? Let's see. Oh, now why is this going back over here? What you're trying to do is you're always trying to figure. I never use this, by the way, Peter. I always use actual numbers. I want to see actual cap rate. So this is just an example. What if your value is $98,500? Okay. Your cap rate is 10%, and your cash out at a sale is $8,500. This is all hypothetical stuff, and I don't even, to be honest with you, I don't plug these numbers in. That's why I don't like them. I don't use them. I like using my own numbers. You can use that if you want. But what they're saying here is if you were to sell under these circumstances, what can you reasonably expect in a cash out? In this case, it's $8,500. I would never sell this property under these circumstances, okay? I would keep this one. I'd keep it for 10 years and let the values go up because I know the area, and I know that the $112,000 property, Bedford, New Hampshire, is going to go to, in 10 years, it's probably going to increase anywhere between 50% and 100% easily in the next 5 to 10 years, okay? So I would hang on to that property, Ray, or have your investor hang on to it. That sounds like a pretty good deal. Even though the rent doesn't look favorable compared to the purchase price. In other words, you just have a little bit better than a 1% ratio, gross rents to purchase price. The fact is the interest rates are so low right now, you can still get a very nice cash flow $4,800 a year of cash flow is not a bad deal on a single-family home. So cap rate, even though it's only 8.8%, I'm pretty sure this property is going to, by the way, single-family homes, folks, always appreciate more than multi-units when it comes to rentals. Never fails, okay? So I would take this deal. If I was them, I would take this deal, all right? You might try to restructure some of it. You might say, I'll give you an idea here, Ray. If you want to, by the way, Ray, is this figure hard and fast? Is it absolute? Is it under agreement right now for 112.5? Oh, Ray, you still there? Oops, I muted him. Hang on. Okay, Ray, you there?
Yeah, I'm here. It's a condo in Dover, New Hampshire, and it's pretty solid.
Okay.
112 is cheap. Okay,
I would take it. That would be my recommendation. You can always bounce it off Dave Gambasini too, but I'm pretty sure he would concur with that. So what I was getting at earlier is if you think there's any wiggle room there, what you could say is, this is an old trick, and everybody make sure you write this down. If you're trying to really get the best deal possible and you're down to within $1,000 or so, have your buyer offer to pay commission and transfer taxes. And then hold on to your seats. I'll explain why here. You're not going to still pay $112.5 if you're paying all those other expenses. What you're going to do is you're going to reduce the purchase price by those amounts. So the net to the seller is still the same. They're still going to get, let's say your commission and transfer tax comes to $112.5. Let's do this. Let's say total commission and transfer tax is $5,000. $2,500. Hang on, let me get my thoughts together here. Let's just work on transfer tax. Let's say transfer taxes is $5,000. Usually you split that 50-50. Seller 50%, buyer 50%. What you do is you say, seller, I will pay your transfer tax, your portion of the transfer tax, if we make the purchase price $110,000. Now the buyer gets it for $110,000, plus he's still got to pay all the transfer tax, $5,000. The benefit to the buyer is he gets to write that off. Okay, he gets to write off the expense of transfer taxes. You can do it on commission, you can do it on a number of things, but those are the two highly most used expenses to pay, where the buyer can pay it, adjust the price, and get a portion of that money back at tax time. If he's in a 50% tax bracket, he'll get 15% of that $5,000 back at tax time. The seller doesn't care because the net to the seller is still the same. So that's just a trick you can use when you're buying investment properties. I mean, we can go into that in more detail in another class, but I just want to make sure you understand there's other ways you can work on the terms of a transaction. In fact, would you guys like me to have a class just on creative means of working out terms, not creative financing, just creative purchase techniques? How do you adjust a price where everybody's happy and you get some more bang for your buck? If you want to do that, just let me know. I'll be glad to do it. So Ray, I'm going to mute you back. Let me go back and find where you are here. Hang on one second. And I'm going to unmute Kelly. So Kelly, oh, that's right, Kelly, you said you don't have a microphone. So Ray, thank you very much for your help. I appreciate that.
Thank you.
Okay. And then Kelly, let's look at your example. Let me reduce this back here. So I'm going to go to questions and find Kelly. So hang on one second. Shannon says, yes, creative purchase techniques. Oh, and Shannon, I tell you what, you're going to love these. We'll do this. We'll touch, if we have time tonight, actually, we'll do it next week, Shannon. I'll touch on them for you. I'll give you 3 things you can use that are awesome techniques in a high-priced area like LA, okay? Let's see. This is, let me go back to Kelly. Okay. Here it is. Kelly says, I would like to compare it to 20% down, 5% interest. Okay, let's go here. So Kelly, your purchase price, I believe initially was $157. So let's plug that in. Okay, and you have no mortgage. For first start off, Kelly, we're going to do no mortgage. Okay, everything's going to be zeros across the board. So no mortgage, no mortgage, no mortgage. All right. Okay. Now you had some additional costs. I think. $2,000 and $5,000 to $7,000, right? Okay, and let's see your rents. Let me go back to your other expenses here. Hang on one second. Almost there. Okay, property taxes. Let's go. Let's scoot down a little bit first. Property taxes, $1,500. Okay, oops, $1,500. Let's see. Insurance is $900. Okay, and let's see. Monthly rent, $1,350. There it is, $1,350. And I believe, Kelly, yours was a single-family home too, right? Yeah. Okay. Purchase price $157, $2,000 plus $5, another $7,000 cost. Monthly rent's $1,350. Insurance and property taxes $900 and $1,500 respectively. Okay. So let me go back down to Kelly's request to see a comparison. So I'm going to I'll hold that for a second. Now let's go down here, Kelly, back to the chart, and we're going to page up. Okay, so far so good. We got all that. We got our rents. There it is, that adjusted. So let's say maintenance repairs, let's keep 600. Legal, advertising, let's keep those. So annual debt service, there is no annual debt service. All right. So now you see your cash before taxes is the same as your net operating income, $13,050, and you have no debt coverage ratio, okay, because you have no debt. Your cap rate on this one, Kelly, is 8.3%, okay, and here's your what if you want to take a look at that again. I would, and they're assuming value is 130,000, and your cash out you sold for 130. Why would you do that if you just bought it, for 157, right? That doesn't make sense. So that's why I never understood why they put this out there. I'd rather see you use this rental property reporter, and we'll look at that here in a little bit. So hang on one second. Let's go back to this. So let's go back to Kelly's example. Now we're going to assume a down payment of 20%. So let's see, let's call it 160, 150,000 down payment is going to be 30 plus another almost 3,000. Let's call it 33,000 down payment. Okay. Interest rate is 5%, and for 15 years term, and we're going to say 15-year payment period too. Okay. So now you've got the number of payments per year. Sorry, 12 payments per year. You got a $260 a month payment, Kelly. I'm sorry, I did that wrong. Your out of pocket is $33,000. Your loan's going to be $164 minus $33. It's going to be $131. So $131. Okay, now that changes things. Yep. Now your monthly payment's $1,035.94. Okay, $33,000 initial investment. You're financing the rest at $131. And initial acquisition cost $7,000. Now you've got your gross receipts, you've got expenses. Now let's see what happens here. Now you've got an annual debt service of $12,000, and yet your net operating income is only $13,000. So you've got an annual cash flow of only $6,019. So your cap rate's okay, 8.3% because of where you are in the country. I understand that, but look at your debt coverage ratio. That's too low for banks. So we've got to change that. And what we do is, you don't want to change expenses because those are pretty good numbers. So what you do is you put down more money. So Shannon, this is what I was talking about earlier. You can use this to play with the numbers. So let's say you're only going to borrow $100,000, okay? And let's see what happens there. Now your debt service goes down to $790, okay? And you can see your initial investment goes up to $64,000. So now your annual debt service is $9,000, which means your cash flow is now $3,500. Not too bad, not too shabby. Okay, that's about $300 a month. And now you can see your debt coverage ratio goes up to 1.375. So I know banks right now, a lot of banks will take a debt service ratio of 1.2 and 1.25, so you're above that. Some of them are still hanging around the 1.75 mark. That's really aggressive. They're going to find themselves not getting much business. But you can find loans, you can find banks that will cover this property, Kelly, at 1.375 debt coverage ratio. Okay. So hopefully you guys can see how reason I love this calculator so much is it's a very powerful, fun, easy to use tool. Okay. All right. Now let's do this. Let me scan down here real quick and see if there's any additional questions, because I know we're running over. I apologize, but I want to make sure we cover this. Okay. Whoop, hang on one second. Let's go back here. So let's do this. Let's take this is everybody got this. The link is it's called allpropertymanagement.com/resources/rental property investment calculator. I'll leave that up there for a while, but everybody should have gotten this with your initial information on the training program. So let's see, current value. Let's assume we're going to take let's take a raise that was 112.5. Okay, oops, too many zeros. Cash investment, I think we said that was going to be like 22,000. Okay. Oops, sorry, that's a percentage. So 20%. So you see how this is different? I like the fact that we can plug in a percentage here. We don't have to, and it'll calculate the cash amount. All right. So we're mortgaging 90,000. Mortgage rate, let's say, is I think we said 3.75. Okay, and there's some assumptions here. Let's click on the assumptions and see what they say. Loan term, 30 years, which is 360 months. Purchase cost, 1%. Let's just leave those assumptions there. Okay, expected rents, I think we said are $1,200 per month. Oops, $1,200 there. Okay, so right now we know where we see that our cap rate says is 12.8%, but we're not done yet. We got to figure out some more information. So vacancy, we said we're going to make 0. Rent increase, let's make that, you know what, 4% is not bad, but let's be conservative. Let's make it 3. Some parts of the country are going up at 8%. Some are going up at 2%. Okay. Now, property improvements. I'm going to leave that 0 for now, Ray. But let's see what some other assumptions are. 0 for management maintenance. Let's keep it 1%. Insurance costs. Let's keep it 0.5%. Move in, move out costs. This is the cost when people vacate and you've got to go in and clean and paint. Let's just make that 1,000. Okay. Oops. 1,000. Okay. Sale of the property. Let's assume we sold it. And this was after a 5-year period for 136. Appreciation rate of 4% per year. Let's make that 3. Let's be real conservative. And sales cost, we actually should probably make that 10%. Okay. Yeah, 10%. So what this is going to do, oh, by the way, value of land, let's say that's 5% of the total purchase price. All right, so your tax basis is 106. In other words, 112 purchase price minus the 5% for the value of the land leaves you a building of tax basis of 106, all right? Property tax rate, let's call that 3%. Okay, let's look at some other assumptions here. Your tax rate, let's leave it 25%. Annual capital gains 15%. Inflation, let's leave it 2. Investment hurdle rate, and what this is compared to other investments like stocks, bonds, mutual funds, what have you. What's the hurdle you have to get over to make this a decent investment? We're going to assume you can make 8% elsewhere. All right. So let's look at some of the results here. You guys with me so far? Okay, good. By the way, you can. This is one line here, one line of data. So your initial out-of-pocket cost is $22,500. Cash flow. So your cash flow, by the way, is negative right out of the gate. Cash flow first year, cash flow second year. You can see at the very end, and the 5th year includes your sale. Okay, so if you sold your property in 5 years, under all these assumptions, okay, your tax rate, your the property tax basis or cost basis for property tax, the cost of selling the property, cost of improvements, maintenance and repairs, cost of vacancies, and also your debt service. All that accounted for, if you sold it in 5 years for, what would you say, 130 and some change, yeah, you would net 26,916. So basically on 22.5, you would make an additional 26,000. You would basically more than double your money. Not a bad deal. Okay. Now I don't want to go into all these details because we're running over, but I want to click on this and show you what you should do on your own. Click on that. It says show more details, and look what you get: cash flows and return on investment details. Okay. I want to slide this over so you can see more. You get all of these figures. Okay. Awesome information. You got to pay off your mortgage here, for example. That's 80,000. Everything is provided for you in a table format. You get your ROI percentages, okay, over the 5-year period. So what they call is a walkaway price. That's something that they, if you couldn't get this on your property, you would walk away. You wouldn't sell it. Okay, if you get this or better, you would basically take the deal. All right, that's assuming that the sale price is for that amount. I mean, look at all the stuff that this gives you. Look, there's more. You can click on yearly financial projections. Okay, you can click on return on investment ROI tables, table details. Okay, and year-ending balance details. Okay. All this is available to you at your fingertips. And if you don't know what all this stuff is, then what you want to do is actually practice, guys. Practice makes perfect, all right? For example, you can see what happens to your loan balance over a 5-year period. You can see how much interest you pay each year. You can see the principal reduction. You can see the mortgage payments you're actually making. Your ROI, your yearly appreciation, because you're taking the appreciation on your property, all right? Appreciation, how much the property goes up in value, less taxes, all right? Cash flow, your increase to your net worth, and basically your overall ROI. This is awesome information. If you really want to wow your investors, I suggest you play with this tool. Get used to it. It's free and offered to your clients for free too. All right. So let me go back here. Check questions one more time. And let's see, this is Ray. Hey, Ray. Okay, Ray says, why would you sell a rental? Seems like we would keep them forever. I guess they get old, or is it part of the tax scheme? So, Ray, that is a loaded question. And the answer is it depends, because everybody's different. Everybody has different different needs and wants, okay? I know for me, my average hold time on all my rentals was about 12 years. Some I own 10, some I own 14, some I own a lot more than that. But here's how I determine when I would sell a rental property. Okay, obviously you buy rentals because you want to be in the cash flow game and you want cash flow coming in. Now, what happens though is because it's a tangible asset, it is going to require maintenance and repairs. It's also going to require capital improvements. Big ticket items like windows, roofs, furnishes, kitchens, things like that. So what I do is I do an assessment of all my properties every year. I look at the numbers every single week, and I look at them monthly. I look at them annually too. And then if I find a property in my portfolio that's doing well, but it looks like I'll need a roof in 5 years, okay, or I'll need a furnace in 3 years or something like that, I'm going to decide, I'm going to figure out what is the cost of the roof, what is the cost of the furnace, add that to my cost basis, do all the calculations again, see what my returns are then, and determine if I want to keep it versus selling it. And then I do the calculation, if I sold it today under its current circumstances without making those improvements, how much money would I get in a sale? And I look at the value of that money. In other words, what can I do with that money? And if it turns out I can use that money more profitably doing something else, then yes, I'll sell the property. If, however, putting on a new roof and putting in a new furnace makes the property more valuable, which of course it will, not by much, but it will, but allows me to raise rents, and over time, and again, this is all a projection, over time I believe I will recoup my investment, okay, on the new furnace and new roof, and that return is greater than I believe that my return would be by selling it now, then I would keep it. So that's a long way of saying, Ray, it's on a case-by-case basis. I have sold properties that I've owned as little as 7 years, and I wonder if I can give you an example. I think when I did that, honestly, it had nothing to do with the property or nothing had to do with the area. The fact is I had another opportunity, and that was an easy property to sell because I think I had no debt on it. I had already paid off the mortgage, and more importantly, it was in good shape. So I took it and sold it. In fact, I sold it in less than 30 days, took that money and redeployed it for a larger property. Okay, so by the way, that's a very common reason why people will sell, because they want to redeploy that money to buy bigger properties. In fact, I can tell you, I started moving up from the duplexes to the bigger properties, eventually got to the big buildings, and now I won't buy anything less than 50 units. I know that sounds crazy and out of reach for some of you right now, but I tell you what, guys, 30 years ago, literally this month, 30 years ago, on the 20th of January, 1986, I bought my first property. I didn't even own the whole thing. I split a house with my college roommate, Socrates. We each owned 50%. So my first step in the investment game, I only bought half of a property. And now look at how it's progressed over the years. So don't worry about, hey, Gary, I can never get that big building. Don't worry about that right now. Is think about, hey, Gary, how can I get my very first property? And you keep that carrot dangling in front of you. Keep working with me. I'm going to help you get there, all right? So even if it's a half a duplex, you split a duplex with another investor, at least get in the game, okay? Roll up your sleeves, take off your shoes, jump in that water, and get swimming, all right? You've got to start somewhere. You've got to start, and there's no better time than now. I mean, nothing worse than looking back and saying, gee, I wish I'd have done this 20 years ago, okay? I'm not lucky. I've had as much bad luck as I've had good luck, and when people ask me, I look back and I say, you know what? I'm just grateful that I gave myself permission to take action all those many years ago. I'm not any different or better than anybody else. In fact, there's many of you guys that are far more intelligent than I am, right? So in any case, sorry about the getting off on a tangent there. But I hope tonight was helpful for you guys, particularly the newer folks. Once you grasp how to use these tools, now like Ray and Dawn, okay, and actually this came up with Scott Mosley and I were having a great conversation the other day. I was driving down from, I think I was coming from Knoxville down to Orlando, or maybe I was driving to Knoxville from Ontario, and we talked about that very same thing. Once you learn how to use these tools, and it just took us 1 hour tonight, all of a sudden you realize how much you know. He found himself in a conversation with another lender, and the lender was surprised at what Scott knew, and he said, hey, man, I think you've got some pretty cool tools there. And Scott said, I really surprised myself at how much I actually knew. Matter of fact, Scott's on the webinar tonight. How you doing, Scott? Let's see, Scott. Hey, Scott, you mind if I unmute you for a second? Let me do this real quick. Hang on 1 second. Scott, you there?
I'm here.
Excellent. Yeah, you and I had an awesome conversation the other day on the road. There was a couple things you mentioned, and I think one of them was when you realize how many recordings are out there on the website from prior webinars. So I'd love it if you can, in your own words, tell me what you realized when you discovered that and what that's meant to you as far as your learning curve goes.
Well, I think for me, and I think everyone else will find this out too. I've been through all the modules and gone through all the training, but once I finally got access to the members only area, go through. I can't express this enough. This is one of the things Gary and I talked about, and I'm glad that you unmuted me so I could share this. Go through every one of those videos, even if you think that it's been covered, or even if we talked about it tonight. There are always golden nuggets within those webinars, the recorded ones. Even more so, it expands upon the modules. The modules are detailed. You get a lot of great information, but there's always nuggets from other students that have asked, or a question that comes in via email that Gary expands on even in detail. It's amazing how much you learn from those recorded webinars. So I highly, highly encourage everyone, the minute you get access to that, watch 1 or 2 a week, watch them multiple times, and you'll be amazed how much information you'll gather and how knowledgeable you'll become whenever you do sit down with a seasoned banker and they'll start asking you questions. You're like, wow, I really do know more than I thought I knew. again, those recorded webinars are very, very vital.
Well, thanks, Scott. I feel like I owe you $20 or something for saying that. But actually,
I'll bill you for it.
Yeah, that's cool. And we're not actually, obviously, we're not selling anything. I just want people to realize how much is out there. I mean, what's available on the website. All the interviews with folks like Kelly O'Keefe up in the Boston area. Man, that is an awesome, awesome interview. Another one's coming up another week or two. Rob Caldwell. He owns a property management company. Listen for that one out next week, the week after. They're all out there. They're all recorded, as well as these weekly webinars. So for guys, take Scott's advice and load them up, put them on your phone, and listen to them when you're in your car. So, well, thanks, Scott. I appreciate you sharing that. I'm going to put you back on mute. And,
my pleasure, brother.
All right, take it easy. And for everyone
you too,
else,
man.
all right. For everyone else, I'm going to look one more time for questions here before we wrap things up. So hang on one second. I think that is it. I think we're all caught up. Okay, let's see. Let's see, Anastasia. I know you're on the webinar, and Anastasia, I did get your Facebook message. I was teaching today in Kissimmee, down at the Celebration office south of Orlando. So I'm going to get back to you, Anastasia, about what you're doing with Angie. I think that's next week, and let's see if we can work something out. Okay. For everybody else, I hope you are having an awesome year so far. I encourage you to stay engaged, network with other people in your area, because we've got about 400 people across, Montreal to Miami and California to Maine in the program. There's a lot of good networking that's going on, all right? And we've got some veterans that still participate who've been in over than a year, and you can learn a lot from them. So stay tuned. Roll up your sleeves, practice this stuff, take action, and I promise you're going to start getting results, okay? And some people are already out there buying their own properties, which is wonderful to see. I love seeing you guys invest yourself. I want everybody to do that, okay? Okay, everybody have a good night, and we will see you. Oh, let me tell you this real quick. I'm sorry. Next week, the webinar is, let's see, Tuesday night, the 12th, okay? And I'll be back in the Orlando area next week. The week after that, I will be down along the Florida coast on the Atlantic side, Palm Beach, mostly around the Palm Beach area, the Weston area, at Ventura. Then I go to a mastermind group the last week of January. Then the first week of February, I'll be in the Tampa area. Okay, then after that is family reunion. And the last week of February, I've got Phoenix. And then I'll tell you what's happening in March for all you Californians here. Good news. It looks like I will, in fact, be back in Southern California the weeks of March 14th and March 21st, teaching in and around the LA area. So for Shannon and everybody else out there, if you want to do a workshop, that's what I'm going to talk to Anastasia about here in Orlando. As long as I know a week in advance, I'll try to make arrangements to meet you at your workshop and get up and speak for a few moments and help you out, okay? So keep that in mind. That's where I'll be, and I will see you guys next week. Hope you have a wonderful weekend. Okay, bye-bye.